Imagine an ETF that doesn't just buy all 500 companies in the S&P 500, but instead picks only the strongest performers and rebalances regularly so you're always holding the winners. Sounds like a cheat code, right? That's exactly what these ETFs do. And today we're comparing two UK listed versions against the big US benchmarks QQQ and the S&P 500. And the results might surprise you. Hello everyone. If you're new here, my name's Chioma. Before revealing the two ETFs, let's quickly talk about momentum. Momentum is one of the most powerful market forces. The idea is simple. Stocks that have gone up recently tend to keep going up, at least for a while. It's not magic, it's human behavior. Think of any stock that's gone on a mega run recently. Often, it's more about FOMO than fundamentals. But momentum fades. That's why momentum ETFs rebalance, constantly kicking out the laggards and loading up on new winners. Get it right and you can outperform the market. Get it wrong and you're just chasing yesterday's story. Let's break down the ETFs. First up is IUMF or IUMO. This is the iShares Edge MSCI USA Momentum ETF, basically the European cousin of the popular US fund SPMO. It holds around 125 companies from the S&P 500, but only those with the highest momentum scores based on price performance adjusted for volatility. So, if tech's leading, IUMF loads up on tech. When energy leads the market, it rotates into energy. It's a pure play momentum strategy. It has an expense ratio of 0.2%, which is on the decent side. Next is Invesco S&P 500 QVM ETF. PQVG or PQVM. This one's a little different. QVM stands for quality, value, and momentum, three of the most proven factors in investing. Like IUMF, it also draws its stocks from the S&P 500, but instead of just chasing momentum, it blends in quality filters like strong balance sheets and stable earnings and value metrics so you're not overpaying for hype. The result is a more balanced factor fund with broader diversification and less reliance on one style dominating the market. It has a higher expense ratio of 0.35%, but it also pays out a little dividend of 0.79%. How do they compare? In the past year, IUMF jumped 18%, not far off the Nasdaq 100 via EQQQ, which returned 20%. PQVG delivered 13.2%, just behind the S&P 500 via VUAG, which returned 15.6%. So when markets were hot, momentum clearly worked. IUMF was right alongside the Nasdaq growth leaders. But zooming out gives us the real picture. Over 5 years, PQVG averaged 15.4% a year. That's well ahead of IUMF at 9.6%, and it even edges out both the S&P 500 at 14.4% and Nasdaq at 14.5% annualized. That's impressive. A factor ETF not only keeping up with QQQ style growth, but actually outperforming it over 5 years. What explains the difference? It comes down to strategy. IUMF is pure momentum. It booms when trends are strong, but it lags when markets are messy. PQVG, by mixing in quality and value, smooths out the ride. It doesn't just chase winners blindly, it filters for durability. That's why PQVG has delivered stronger long-term returns, while IUMF tends to shine in hot momentum phases like last year. Meanwhile, the benchmarks are exactly what you'd expect. The Nasdaq 100 dominates in big tech bull runs, but can be brutally volatile. The S&P 500 is slower and steadier. Never the top, never the bottom, just reliable. So, should you invest in IUMF or PQVG? If you want the S&P 500 with a twist, either of these two ETFs can work. If you want pure momentum tilt, the strongest stocks right now, IUMF is your go-to. If you want something more balanced, PQVG has quietly delivered one of the best 5-year records of any factor ETF in Europe. And of course, if you'd rather just stick to the classics, Nasdaq 100 and S&P 500 trackers remain unbeatable in simplicity. For me personally, I like these factor ETFs as short-term fringe plays, not core holdings, but tools are used to lean into trends and play shorter bull runs. But what about you? Would you bet on momentum ETFs like IUMF and PQVG, or stick to QQQ and the S&P 500 long term? Let me know in the comments. And if you like this breakdown, check out my other ETF deep dives Just click right here and I'll see you there.